All right, so we're on chapter 13 of Principles of Accounting 2. And in this chapter, we are going to talk about stockholders' equity. Primarily, stockholders' equity is when we are a corporation. So we've talked about this, just touched on it a little bit through Principles 1 and Principles 2, but now we're getting into the meat of a corporation. Okay, the first video I'm going to do will cover learning objectives 1 and 2. And then the next one will be 3 and 4, and then 5 and 6. And we won't do learning objective 7. Okay. All right. So the very first one, we're going to identify the characteristics of a corporation. Okay. So I'm going to come over here and I'm going to draw my big pie. Remember, I said that corporations is like a pie, and those shares everybody owns, all the stockholders, they may own one or two shares. You could have one stockholder own every share in the corporation. That would be a privately held corporation. It's still a corporation legally, but they're not selling stock to the open public. Okay. Corporations dominate business activities in the United States. Okay. It's the most well-known companies are corporations. Okay, so we have a lot of corporations, and a lot of people don't really even understand how corporation actually works. Being incorporated it seems like it has become synonymous with something really bad. Okay, it's really not. Corporations are taxed here at the corporate level, so they're taxed the first time here. Then the stockholders are going to get their money out of how they're going to get their money out of the corporation is through dividends. And then those dividends are going to be taxed the second time. Okay. So that's a huge disadvantage of a corporation is the double taxation. Okay. So when people tell you that corporations don't pay their fair share of taxes, they do. Because who are these happy little stockholders? They're not just Elon Musk and Bill Gates. They're me and you. Because if we have some sort of retirement plan, investment, we have ownership in some of these corporations. Okay. So that's our money being taxed again. Okay. So, but why are we willing to accept this double taxation? Well, we like it because if I just say I am happy little stockholder and I own one share of Walmart stock, one share, then Walmart goes bankrupt. Bankruptcy court cannot pierce this bubble. You may have heard this as the corporate bubble. There is times where they can pierce the bubble, but if I paid the legal amount, at least the legal amount for my share of stock, then they can't cross this bubble. I may lose what I have invested in that one share of stock, but they can't come take my house, my car, or anything like that. And remember, if you're sole proprietorship or a partnership, you have unlimited liability. Okay, unlimited liability. So if something happens in the business, they can cross over into those personal assets. Okay, whereas a corporation cannot do that. So we're willing to accept that double taxation to help us not be liable. Because how sad would that be if Walmart went bankrupt and then they're going to cross this bubble and creditors are going to come after us? They're not. Okay. That is the corporate way that it is handled. Okay, so some of the characteristics we have separate legal entity. We have number of owners, could be one, it could be a million. Okay, there is no personal liability of the owners. I just mentioned that. There is lax mutual agency. So if the people working inside of Walmart make bad business deals, they really don't affect me. Okay, because they can do whatever and it's not going to affect my personal assets and financial stability. Okay, we do have that double taxation. They can, ha getting capital is one of the huge reasons that a lot of people will use the corporate form of business because if it's a sole proprietorship, then like I can only go to the bank and borrow so much money. I can't borrow a lot of money just based on me. we can do this corporate form and then we can open that pool up to many people who might want to invest in our corporation. So primarily that's the reason why they incorporate is so they can pull a lot of money into it by issuing stock or borrowing money. Okay. So we have some advantages and disadvantages. Advantages, they can raise more money than a proprietorship or partnership. The corporation has a continuous life. It's not going to die. So if I'm happy little stockholder up here and I die, I own one share of Walmart stock, nobody's going to miss a beat. I don't care. I mean, they might care, but they're not going to send out a sad news email about this one shareholder who owned one share of stock. And then my heirs, whoever, you know, inherits my estate, they will get the share of stock. So transfer of ownership is also a a big advantage of corporate form of business. Okay. We mentioned no mutual agency among the stockholders in the corporations, and the stockholders have limited liability. Disadvantage. Ownership and management are often separated. In the accounting world, we like when the ownership and management is separate. And we'll kind of talk a little bit about that when we are in audit. Because if you make the people who work inside of your corporation, especially anybody that has access to the accounting information, if you make them stockholders, then they are going to be more inclined to perpetrate a fraud to make those books look really good because their bonus could be based on how many shares of stock or their stock appreciating in that company. So sometimes they think that's a good thing in the accounting world. We that would be something that would be a red flag to us that we would want to go and look at that and make sure that that management is doing everything right. Okay. The earnings are double taxed. There is a lot of government regulation, and a lot of that government regulation is very expensive. So corporations have to have an independent auditor come in and audit their financial statements every single year. That is the government oversight. Okay. Startup costs are a lot bigger when it comes to a corporation rather than the other forms of businesses. Okay. All right. So we have a couple of different things here when it comes to stock equity basics. I'm going to kind of jump down here because I don't like just giving you definition of those. I want you to see another diagram that's, I think, after this one. Yes. Okay. This is what a stock certificate looks like. I've actually seen one of these before. I don't think I've ever seen a bond, but I have seen a stock certificate before, and it has all this information on it. Most of the time, if you buy stock in a company, you're not going to be the one keeping this. The broker, whoever handles all of those stock exchanges, they'll be the ones that'll hang on to those stock certificates. Okay. So they talked a little bit about authorized, issued, and outstanding. And I really like this diagram. It's a little bullseye. The outer layer is always going to be the authorized. Okay. Authorized is the maximum amount of number of shares they can actually issue. Okay. Most companies will not issue 100% of the shares they can because they want to keep some in their back pocket in case they need to issue some more and pull some more money in. Okay. Then the next one is authorized. This is basically issued, but I'll tell you the terminology they use when we get there. Okay. These are the stocks they've actually issued. Okay. They've issued them. They are not all outstanding though. Okay. Then the next circle in here is outstanding. So you see where it says authorized, issued, and outstanding. Okay. The only difference between these two right there is something called treasury stock. Okay. Treasury stock. Okay, that is where we're going to talk about it in this chapter and do journal entries for it, but that is where the company went on the open market and they bought their own shares of stock back. Okay, now we don't necessarily have to have treasury stock. If we don't have any treasury stock, then our little circle is going to look like this. We're going to have this is going to be authorized and this circle will be issued and outstanding. So if you don't see three different numbers, authorized, issued, and outstanding, then they don't have any treasury stock. Okay, so just remember the difference between those two right there is treasury stock. Okay, stockholders do have some basic rights. Okay, they do get the right to vote. We used to own some shares in Performance Food Group a long time ago, and they would always invite us to come and vote on things out in Richmond, Virginia. We owned 5 shares of stock. We weren't driving all the way out there. We just didn't, our vote didn't count. So I'm guessing somebody could have proxy voted, but never did that. Um, Stockholders do have the right of dividends. So when the company is actually declaring dividends, the stockholders are the ones who are going to get those dividends. Okay. When there is liquidation, I always like to draw the accounting equation out here. If we have liquidation, we are going to sell all of our assets, sell all the assets, and then we're going to pay off all the liabilities that we can. If there's anything left over, then the stockholders will get it. Okay. Chances are, if this company has not been doing well, they might sell all the assets and still not have enough money to pay all the liabilities. So in that case, stockholders will get nothing. Okay. They actually won't get a bill for it either. That company is probably filing bankruptcy. Okay. So they do have the right for their proportionate share of assets after liquidation. Okay. Then we have the preemptive right. Preemptive right, this just means that your shares, your percentage of shares can't be diluted. Okay. What does that mean? So let's just say I own 10% of Walmart stock. If Walmart goes out and tries to issue more stock, they have to give me first pick, preemptive first pick of the stock so I can keep my 10% and my 10% doesn't go down to 9 or 8 when they issue stocks to other people. I can refuse to buy any more shares and then they would go sell them to somebody else. But I would get first pick. As a current stockholder, I would get first pick if they wanted to issue some more stock. Okay. So I've drawn that accounting equation out. I'm going to draw it out again, but we're going to go into a little bit more detail of that stockholders equity section. So I'm going to do this. We'll come over here. We have stockholders equity. Okay. We have three main categories that branch off from stockholders equity. Okay. The first one is the contributed capital. Okay. Contributed. This is where investors put their money in our business. Okay. We can't pay dividends out of that. Okay. Then the other one is retained earnings. Retained earnings is exactly what it means. It's all the earnings from the beginning of this corporation minus all the dividends that have ever been paid. Okay. So that's a balance that rolls over every single period. Okay. Remember your owner's equity, debit, and credit rules. So underneath here, remember to increase these. We're going to credit them. That works for both of these. Okay. And to decrease it, we would debit it. Okay. So that's why it's really important to follow those debit and credit rules because remember, equity has that normal credit balance. We have the other one over here is called treasury stock. Remember, I mentioned that a minute ago. That's where we went in the open market. We bought our own shares of stock. Treasury stock is a contra equity account. Okay. What is contra equity? Let's just write that here. Do you remember way back in Principles 1 where we talked about accumulated depreciation? It was a contra asset. We are going to talk about a contra liability here in the next chapter, but contra equity is going to be opposite of what regular equity is. So we see right here, normal credit balance, the contra equity account will have a debit balance. Okay. Treasury stock as a whole will bring stockholders' equity down. Okay. So we have common stock and preferred stock. Both of those fall underneath contributed capital. Okay. The stock will have a par value. Par value is the legal amount of that share of stock. This is usually a small number. Because remember, when I was introducing this, if I paid my legal amount of that stock, they can't cross here. But if I got too good a deal, so if the par value is $5 and I paid $1 for each share of stock, that is when they can pierce that bubble. Okay. Par value is just an arbitrary number that is assigned to each share of stock. It doesn't mean a whole lot, but it does affect our journal entries. Okay. So we have stock that has par value. We have some that has no par value. And then we have stated value stock. The great thing about this par value and stated value, the journal entries are almost identical. Okay. So you don't have to think just a whole lot. And if you're thinking to yourself, the account titles are getting much bigger. Yes, they are. The account titles are getting much bigger. Okay. I already mentioned the two basic sources of stockholders' equity. Sometimes they'll call contributed capital paid-in capital. That can be a little confusing because some of our account titles are going to have paid-in capital in there, but paid-in capital means the same thing as contributed capital. Okay. All right. We're going to do learning objective 13.2, and we are going to learn how to do the journal entries to issue stock. Okay. Usually, the company, like Walmart, they're not the ones handling this. They usually hire an underwriter or somebody else, another business that will take care of that for a fee, of course, but they usually take care of that. Okay. The issue price is the amount the corporation is going to receive from issuing the stock. Okay. So they give us an example here. SmartTouch Learning's common stock carries a par value of $1 and the charter authorizes 20 million shares. That's the big circle, remember? Authorized. It says the stock issuance of 15,000 shares of stock at par value is recorded as. Okay. So they're telling us it's going to be issued at the par value, not 20 million shares, only 15,000 shares. Multiplied times 1 gives us $15,000. Okay. We're going to debit cash. It's going to be the first thing we're going to debit because we are getting cash from this transaction. We're getting the cash. We're the business. Somebody else is investing in us. Okay. So we will credit the account called common stock, $1 par for 15,000. This one's super easy because it was issued at par, which is probably almost never going to happen. Okay. So let's do another one. So SmartTouch Learning issues an additional 3,000 shares at $5 per share. Okay. So getting $15,000 cash again, but we're issuing a lot less shares. Okay. So let's figure out the cash first. Remember, I'm always telling you that. Figure out the cash. Cash, we got $15,000. Okay. We are only going to put in this common stock account the par value. We don't mix up the extra. The extra was the $4 over the par value. So we will credit common stock $1 par for $3,000. Okay. All right. So that's how much goes to common stock. And now we have a difference of, is that 12,000? We could take 3,000 multiplied times $4, and that would give us 12 as well. Okay. We're going to credit a new account. This one's got a big account name. Okay. So beware. So we have paid-in capital in excess of par, common, $4 times the 3,000. We did it up here a little bit differently. The math should work. Okay. because we only issued 3,000. Just because we got the exact same amount of cash does not mean these journal entries are the same. In that first entry, we issued 15,000 shares. We only issued 3,000 shares in this entry. Okay, so moving on, let's look at what does the stockholders equity section look like. It looks much bigger than you've seen up to this point because all we had was one sole proprietorship, H. Solano Capital. That's all you had. Now it's a bigger section now. Okay. Like I said, they call this paid in capital. It can be called contributed capital. Okay. Then we have our common stock, 18,000, because that was the 15,000 plus the 3,000 shares. It says right here 18,000 shares issued and outstanding. Okay. The only time we would have a difference in those is if we had treasury stock, and we have not gotten that far here. They gave us a retained earnings number, and that gave us the total stockholders' equity. Okay. All right, we're going to do another one. We're going to say Smart Touch Learning's common stock is no par. We're going to assume the company issues 15,000 shares for $1 and 3,000 shares for $5. Okay, if there's no par, we don't know the difference. Okay, so we are going to take the 15,000, debit cash, credit common stock, because there's no par value, which this was the exact same entry even with the par value because they sold it for $1 a share. Then the second one, notice we didn't separate out the extra because we have no par value. Okay. No par value means this account, this paid in capital in excess of par, doesn't exist because we don't have a par value. Okay. Let's see. Now, oh, look here. They gave us the stockholders' equity after those two transactions. We just have one account, 30,000. Okay, that's just common stock. The thing is, we don't know how much, we don't have necessarily a number to figure out if there was a premium here. Okay, retained earnings was the same. Notice these two numbers were exactly the same, the 33,550. Okay, one's not really necessarily better than the other. One has a par value on its stock. This one does not have a par value. Okay. So now let's talk about stated value for common stock. Remember I said stated values handled almost identical to par value. So in this problem, we have 3,000 shares of $1 stated value. You could put par in there. It means the exact same thing. And our journal entry would be to debit the 15,000, debit common stock. Just note it, the only difference is right here it says stated value, not par value. And then we come down here, paid in capital in excess of stated common stock. Okay, so really just the account titles changed on this one. Okay. And now they are going to give us another example because we could get another asset besides cash when we issue stock. So Smart Touch Learning receives furniture with a market value of 18,000 in exchange for 5,000 shares at $1 par. So yeah, they said $1 par. All right, so we're going to record. They said it was the market value of the furniture is 18,000. We are going to use the market value. If we can't find the market value of the furniture, we will look to the market value of the stock. Okay. So furniture, we're going to debit furniture for 18,000. We will debit common stock $1 par for 5,000 because we issued 5,000 shares at $1 par value. And then the rest of it is paid in capital in excess of par. Okay. Notice nothing really changed about this transaction here. We just didn't get cash. We got furniture. Some people may have that. They may, like, probably the classic example is they had a, whatever stockholder it was, they didn't have any cash. They had a building. Hey, we're going to throw this building in there and I'll get some stock. Okay. All right. Then issuing preferred stock. everything you learned from the common stock will apply to preferred. So we have Smart Touch Learning issues 1,000 shares of $50 par, and that's really typical. You'll see a $50, you'll see a higher par value on preferred stock. This 6% has to deal with dividends. I don't think we're doing dividends in this one. I believe we'll count for dividends, yes, in another learning objective. Okay, so 1,000 shares, $50 par, and then they did that for $55. So 55 times 1,000 gives me 55,000. The par values, the 1,000 times the 50, goes into preferred stock. My extra, my premium of 5,000, it's paid in capital and excess par, little hyphen, preferred. The other ones just had common. Okay, almost the same. So try to figure out these things that are the same, and that will make it easier to memorize and know what you're doing. Okay, and so now you can see our stockholders' equity with preferred and common. They're always going to list preferred first. The paid in capital will go with the preferred, then the common. Preferred stock is not very common. I mean, it's not common, kind of a play on words, but it's not common at all. A lot of businesses don't even have a preferred stock. And most of the time, preferred stock doesn't get to share in some of the benefits that common stockholders actually get to share. The biggest thing on preferred stockholders is they get their dividend first. Okay. They get their dividend first, and that's really all they do. All right. We will pick up in the next video on learning module 3.